you're thinking stuff that's more current. In fact, I think I've already said most. Did I leave a lot of blanks on this slide too? Okay. Oh, I'll go back and can I move forward and then go back? Okay. I'll go back at the end. Is that all right? Okay. You got the gist of what I was saying, right? Good. So you can do a horizontal analysis. You can do vertical analysis. So horizontal, right, like horizon. You go like across. Vertical, you're looking up and down at the same financial statements, okay, and trying to analyze within the financial statement, within each year. Okay? You can do a vertical analysis and then a horizontal analysis, whatever works. So let me move forward with this. So working capital is taking current assets and current liabilities, will give you a sense of how a company can satisfy its short-term obligations. So if you look, so let's think about what some current assets are. What might be some current assets? Cash. What might be what? Accounts receivable? Inventory. So, right, and so current liabilities. What might be some current liabilities? Whichever is longer. Right? No, that's operating. Okay. So, so what you want to understand here, so this is our working capital, our current assets minus our current liabilities. Obviously, you want your current assets to be higher than your current liabilities. You want to know that you can satisfy your short-term obligations. So the current ratio divides current assets by current liabilities, so it gives working capital as a ratio so you can compare within firms. So it turns it from a number to a ratio. So you can compare how liquid is one firm versus the other. That makes sense. So you guys got here without, so you have these terms, current ratio, we're going to look at asset test ratio, but you got here, you were able to tell me that liquidity, you're really thinking of things that are current. Okay, you told that to me without even looking at this. So if you think about things that are current and you think current assets and current liabilities, you can express that as a ratio. That's all. Okay, and that allows for inter-firm comparisons. So the asset test ratio is a little more stringent. So our inventories and prepaids necessarily going to help you pay your bills really fast, even though they're current. So the asset test ratio is actually even a little bit more of a stringent measurement because it removes certain items like inventories and prepaid expenses from current assets before calculating your ratio. So if you look here, current ratio is current assets over current liabilities. Asset test ratio, or it's also called the quick ratio, is quick assets over current liabilities. So quick assets can be quickly converted to cash. Cash, short-term investments, accounts receivable do not include inventory and prepaid expenses. And again, as opposed to sort of like memorizing this just if you're in a business and you have to think, how quickly am I going to be able to pay my bills? You're going to look at the cash in the bank. You're going to look at the receivables that you're probably going to receive in the next 30 days. These are the things you're going to really care about. I can sell an investment if I need to and get cash. But you're probably not going to say, well, my inventory is convertible to cash. No, I mean, realistically, these are the things you would look at if you want to know what the cash you're really going to get fast. So even as an example, when I was living out in California working as a controller at this movie studio, we used to often, this used to come up when we wouldn't have a big movie, we would have cash flow problems. So I would have to make capital calls to the investors. They would ask me, how much working capital do you need? I wouldn't look at my inventory. I would look at my cash in the bank. I would look at my receivables. If I had anything I could, that was in the money market, I could quickly get to. But I would look at what bills I have to pay in the next 60 days, 30 to 60 days. These are the things that I would look at and say, okay, this is how much cash I'm going to need to cover. Okay? So this kind of makes sense. So vendors, this is important. If a vendor wants to extend credit to you, they would be interested in these ratios. So potential investors and creditors, I just wanted to bring in some reality there. If you're an investor or a creditor might be interested in this type of ratio. And before they extend you credit and say you can pay me in 30 days, they want to know that you have enough money, that you have enough money to cover these kinds of things if they were to extend you credit. Next, I have here, oh, did I need to stay there? That's okay. Can I move on?